Welcome to the Westside Investors Network, WIN, your community of investing knowledge for growth. This is the Real Estate Professionals Investing Podcast for real estate professionals by real estate professionals. This show is focused on the next step in your career, investing. Thank you for listening, and please, if you like our content, rate us on your podcast provider. Just a quick disclaimer, the views and opinions expressed in this podcast are for educational purposes only and should not be construed as an offer to buy or sell any shares or securities, make or consider any investments, or take any other action.
Welcome back to another episode of the Deal Deep Dive segment on the Westside Investors Network podcast. I'm your host, Trent Werner. In this segment, our featured guests will share their unique stories on a specific deal they've invested in. We will dive deep into finding the deal, financing the deal, writing an offer, and the due diligence. Do us a solid and smash that subscribe button, leave us a rating, and share this episode. And now, let's dive deep. Welcome back to the Westside Investors Network podcast. I'm your host, Trent Werner. On today's Deal Deep Dive episode, we're joined by Kenny Wolfe, Wolfe Investments. Kenny's going to share how Wolfe Investments came about, the different arms of their business, as well as dive into the post office building in downtown Dallas and how he converted that into a multifamily mixed-use property that they still own to this day. Now let's welcome Kenny Wolfe. All right, Kenny Wolfe joining the Westside Investors Network podcast. Kenny, I'm super excited to hear about yourself, Wolfe Investments, as well as the downtown Dallas courthouse deal is what I'll call it. I don't know if that's the actual name for it. Before we get into that deal, though, Kenny, tell me a little bit more about Wolfe Investments and how this whole Wolfe Investments idea and business came about.
Yeah, sure. So I started in commercial real estate in 2010, but came straight from oil and gas accounting. So I jumped right into multifamily value add assets here in Dallas, Fort Worth. That's where we're based in Plano, Texas. And really, jumped in, did 2 passive investments to learn the ropes, build the team that way. I wanted someone else to shortcut any kind of learning curve for me. So that's why I did the passive investments. And then I jumped into a 76 unit deal, syndicated that with 13 other folks for my first sponsored deal in 2012. And then really just snowballed from there. So today we've done over 9,500 multifamily units in 6 different states. We're down to 4. We're in Texas, Ohio, Oklahoma, and Georgia on the multifamily front. And then 7 years ago, added 3 arms of the company. So we have 62 triple net assets as well across the country, Dollar General, Walgreens, CVS, those kind of stores. And then the opposite of that is development. So we also do ground up multifamily development as well. And
currently, what's the biggest facet of Wolfe Investments?
Right now, it's our value add multifamily. That's still about $450 million worth of assets under management there. The triple net's about $150 million. Looking to grow that pretty quickly this year, and then hopefully double it is the goal. And then development, we're probably about $200 million in the pipeline.
And obviously, multifamily was kind of the bread and butter. That's where you guys started. Is there any maybe indication or decisions of slowing that side down, or do you want to keep going with that?
It kind of slowed down for us. In 23. Sales were down 85%. Nothing really traded. And so really our growth last year was through picking up some land development projects in Ohio and Texas. And then our triple net arm kept growing as well. So just multifamily acquisitions really kind of died on the vine. We are seeing, I think this year it's going to be, give it another 30 to 60 days, but you're going to start seeing all these more banks reaching out to sell you assets just for their notes. So we just looked at a portfolio of 8 this week directly from a bank where we can buy them at the note value, which is 35% lower than the peak 22 pricing. So we're starting to see that come. It's pretty quiet still. They're just showing it to a few folks, but it's coming. So that's going to be busy the back half of this year.
Very nice. And I got to ask, you went from oil and gas to real estate. What was the reason behind that?
So my grandfather was in oil and gas. My dad was in oil and gas. So it's what we did. But that industry is way more cyclical than real estate. No matter what we all complain about in real estate, it's way more cyclical. So we had a great run in natural gas, and then it was time to get out back in 2010. So that's kind of when I made that transition to the commercial real estate side.
Very nice. And you're still based out of Dallas, Plano area. We're talking about the downtown Dallas courthouse deal. From what you told me before we started this episode, it was an old courthouse that got, I guess, repurposed or converted
Right.
into
Yeah.
multifamily mixed use. What were the metrics behind that property, and why did you guys want to go after that deal?
Yeah, it's such a special building. It's a historical building in downtown Dallas for many reasons, but it's just a beautiful asset built in the 1920s and hand painted ceilings. I mean, just the original wood floors are there, hand spray. I mean, it's just beautiful. So it's a great asset. We were looking to break into that kind of higher end A class asset class, anyways, and we had bought a few kind of newer garden style in 2018 and 2019 from the developer. So we're starting to break into there. And then COVID happened in 2020. And so this property was on the market in January, February of 2020. It's really called the post office building in downtown Dallas. So that's what people know it as. But there is an active post office still in there. The one downtown is that they're in our building. But it was listed. COVID hit in March, obviously. We ended up calling the broker in May. So, hey, is it still for sale? But they had pulled it in March. And he said, well, everything's for sale. So anyway, so I think we're the only ones that called because we got a showing like that next day. And we walked the property, beautiful asset, love the location. Saw that the rents could probably be bumped up, even though it's an A class. It's there's definitely some value add to there. Also with the commercial tenants, we could bump one or two of those up as well. Pretty much in the short term. So there's some attraction there on the value add piece, and we were able to buy it for $2 million less than the seller paid for it like 3 years ago before that. So just because it was just timing, the patriarch of the family had passed, the kids didn't want it anymore. They just wanted to tap out. And so we ended up picking up for $2 million less than what they paid for it. So it's so that plus the value add rent bumps and we've got a deli in there and there's an event center in there. So there's about 52 couples a year get married in our building. It's that pretty. So
That's awesome. So what's the how many commercial units compared to multifamily or apartments are there?
Sure. So it's an interesting deal. So we own 82% of the building. The post office owns 18%. So it's the strange condo situation we have with the USPS, and they're always threatening to move, but there's no place for them to move. So anyways, so we're co-tenants in there, co-owners in that building. And also, like I said, in there is a deli, stays really, really busy. We've got a family office there that takes up 2 stories of the building and a corner of it. Our event center, we have 2 historic courtrooms that they use for, the weddings, and they have a rooftop deck that they also use that when it's nice outside there. So those are our 3 kind of commercial tenants. And the remainder is 78 multifamily units, all granite countertops, stainless steel. Most have an island with a wine fridge in it. I mean, so we're talking really kind of high end, and it's really a special place to live. I mean, there's some it's more like a history tour when they tour residents through there than just leasing an apartment. So, but anyways, the ladies there do a great job at that.
And are they all single 1-bedroom studios? What are the apartments like? Obviously,
Yeah. Yeah, super nice. When you do a conversion, you have to live within the 4 walls. So you have to live within the box that you bought and are converting. And so there's 78 units, and there's 26 different unit types.
Wow.
So it's a lot, and it's because you got to work around existing electrical, plumbing. A lot of systems you got to work around to make it efficient. And so you have a lot, but it's everything from efficiencies, 1s and 2 bedrooms that we have there.
And so it sounds like most of the cosmetic or construction work was already done prior to you guys buying it. Is that correct?
It was, yeah. There's a group here, a developer here in Dallas that did it back in 2012, and so we bought it in 2020, obviously.
Awesome. Okay. And what's your plan for this deal going forward? You've owned it for almost 4 years, if not 4 years already. What did you kind of project for the whole time on something like this?
We're more of a long-term hold, so our investors they definitely know that when they invest with us. So, but it's about 5 to 7 years is what we say. We've held properties longer, but because the refis have been so successful and we've got all of our cash out, so why not hold it? There's the others that we've sold a year and a day just because we had a really stupid offer come in. So it depends on the asset. This one I imagine is going to be a little bit longer term. the rents in downtown Dallas are really skyrocketing. There's a new property coming online across the street, and they're targeting like over $3, three to $3.25 a square foot for rents, which is since they're newer, it costs them more to do their development, so it should drag our rents up as well. So we're just going to kind of stay behind them by a couple $100 a month, and then should stay full and drag our value up as well.
And for a deal like this, were you planning on refinancing if you haven't already, in the first couple of years, like you talked about, getting cash out and that kind of thing, especially if you bought it for such a good price? Or what was your plan with the refinance and pulling capital out?
Yeah, absolutely. I mean, obviously the debt markets went crazy in 23. And so we had to delay it by it'd probably be later this year or early next when we do the refi. But like I said, yeah, the rents have definitely grown from when we bought it. We bought it, $2 million cheaper than they did a couple years before we did. And then on top of that, we've renegotiated a couple of our commercial leases as well. So we definitely have some growth in NOI that we can take some cash out.
And now here's a word from our sponsor.
Get things done while you're on the move. Learn more about working with a virtual assistant through Offsite Professionals. It's a great way to get all the things done that you need to get done. Have freedom in your time and streamline your life by automating your business. Stop spending time on the tasks that you can delegate and start spending more time on your superpower. Call us today at 503-446-3177 or visit our website at offsiteprofessionals.com.
Uptown Syndication is now offering a syndication coaching program for you to take your real estate portfolio to the next level. This is your opportunity to have experienced syndicators, AJ and Chris Shepard, coach you on your way to controlling your real estate investing future. Our coaching program will provide you with the tools and framework needed to begin syndicating real estate in your target market. Go to uptownsyndication.com today to learn more. And when you underwrote this deal from the beginning, did you have a target, IRR, cash on cash, AAR, any of those metrics that you're able to share?
Yeah, sure. So this one, so for our multifamily assets, we're always kind of at a high level trying to reach a roughly a 18 to 22% IRR. If we don't hit that, or if I don't feel confident we can hit that, then we back off and go on down the road. So this one, we definitely thought we'd double the money to investors in that first 5 years. It's kind of our baseline metric when we first underwrite a deal. But this one, I think, is going to beat that pretty well, and for a few reasons. The commercial, the event space has really taken off, bigger than the prior event tenant there, for sure. And then on top of that, our rents keep getting dragged up because of these newer developments in Dallas. It keep popping up and dragging up the rents.
And do you expect that to continue, just given the last 8-10 years with across the country, everything's kind of going up and everything like that? Do you expect that to continue, or do you have any concerns, given what your conversations with the banks and everything like that?
Sure. No, I mean, so so downtown Dallas is really unique. They're moving very quickly on converting. There's 7 more office buildings that are on the docket to be converted to multifamily. So you're going to see Dallas really come back, and they'll get those done in the next 25 months or less. I mean, it's going to be super quick. So you're going to see a lot more units come back to downtown. Office spaces shrinking in Dallas very quickly, and then with that, it's going to be brand new restaurants, retail, hotels. I mean, it's going to change. I almost want to say overnight, but it's going to change very quickly for downtown Dallas. So that's just going to help that whole part of, and we're right next to 5 of those conversions right now for our property. So we're going to see a lot more new product, but that product is, again, they're going to have to get $3 a foot rents or higher to make their numbers work. And so that's not what we underwrote. So I'm rooting for them to get the $3. So.
And for anyone listening that might not be in downtown Dallas or familiar with it, it sounds like, because I'm in Portland, Oregon, where we are definitely not seeing the office space being converted into apartments and mixed use. We're kind of just sitting stagnant, especially in the urban core. It sounds like Dallas has it, moving pretty quickly and efficiently in terms of getting more housing online for people, as the whole country has a shortage. So that is just one government or people, group of people in charge that wants to bring back more housing versus some other municipalities that may be dragging their feet a little bit when it comes to that.
Yeah, absolutely. Dallas is doing a great job at staying at the forefront of that and pushing these projects along for sure.
Very nice. So what's next for Wolfe Investments? I know you talked about growing the development and triple net side of your business. Is that going to be your main focus for this year, or what other goals do you guys have for this year?
Sure. Yeah. So the triple net's about to. This will be our sixth fund. So we've got five prior funds, and they're great for monthly cash flow. So our investors who need that kind of monthly stable cash flow, those are fantastic for that. But so we'll definitely grow that. Our sixth fund will launch here probably in a couple of weeks to get that going. I think the value add multifamily, like I said, we're just now starting to see these banks offer up these properties they took back for the notes, and that's what they're asking. I'm going to try to get better than that, obviously on the negotiation side. But I think, starting in May, June, July, somewhere right around there, you're just going to see the floodgates open on this multifamily value add that's being sold at a discount. But you're going to have to be able to buy it in bulk because these banks weren't going to want to send it onesies, twosies. They're going to want to sell you 8 or 10 or, some package deal. So you got to be ready to jump on those and be able to raise a lot of money to take down these vulture multifamily deals.
So in summary, you're still bullish on multifamily when the time is right.
Oh, absolutely. Yeah. I mean, like I said, I think that this is going to, or I didn't say, I should say it better. I should say, yeah, I mean, multifamily, it's weird this time, right? So it's we're not overbuilt in multifamily. That's not causing this big discount in multifamily, right? It's just the interest rates doubled on some of these folks that have floating rate bridge loans, and they can't make either the payment or they can't buy the next rate cap to get them there. And so they're having to hand back these properties. And so if you're able to, but some of them are 90% occupied. So it's not really it's not an actual operations thing. It's more it's just a financial crisis, which is great because you buy it at the right price, even at these higher interest rates, you can make some really good money. They just overpaid and not really, and they probably didn't know it, right? But because no one would have guessed interest rates would have doubled. Folks should have known they were going to go up, but not double,
And so when you say that, you could buy some of these assets as they're operating right now and they're going to support themselves, they're going to be good deals. Are you talking about from a debt structure standpoint on just getting better debt on these properties, or what do you mean by that?
Yeah, sure. Yeah. So you're going to, we're first going to ask the banks that come to us with these notes is like, okay, well, do you want to, can you hold the note, but lower the at the amount, give me a 5% interest rate. And again, we're going to ask for the moon and then give me 5 years. Right. And so some are going to say yes, just because they want to get it off their bad loan sheet. And then some are going to say no. So we'll have to go finance those. For those, we're going to ask for a bigger discount than the 35%. Right. For sure. So it's going to be very lender dependent on what they can or want to do for multifamily. But yeah, if you're buying it at a minimum of 35% off of 30 to 35% off the peak pricing, you're going to do fantastic. Basically, what you're doing is they burn through all the equity in that investment when they made it in 2022. So you're coming into a deal where you're all you got to get, if you just get the pricing back to 22 eventually, call it 26, 27, 20, I don't know when, you're going to double the equity. I mean, or more than that, really. So anyway, that's the exciting part is that it's not an actual, occupancy or interest rate or occupancy rents aren't really going down that much, maybe some in some pockets, but the demand is still there to keep driving multifamily far into the future. We're definitely a renter nation going forward. I mean, single family is not going to take a hit. There are too many people that have 3% interest rate loans on their single family home. So the supply is just not going to be there for single family. So the only other option is multifamily. So the demand is definitely going to be there for the long term for housing. So it's not that, it's really just taking advantage of this financial crisis with these interest rates.
Yeah, and I like how you said it's not the same as the last one where everything was oversupplied, overbuilt, and we just had too much for people to to buy and to move into. Because across the country we have a housing shortage, and
Right.
and building has slowed down significantly, at least in our area. I mean, we're
Same here. Yeah.
we're just now starting to see some new developments continuing or starting, but for the last 18 months there was really nothing. So we did have,
and you
that.
really can't catch up for that 18
No.
month break, 2 years, whatever it is. You'll never get that back. And that just is going to compound the supply issue that we have. And it wasn't just Portland, it was all over the country. It slowed down in a big way. Interest rates and the inflation pressures really knocked out a lot of new developments, even here in Texas. You can't get the rents you need to build a new property in the tertiary markets for sure. Dallas, Houston, you can probably still get the rent. San Antonio, like an actual, the larger cities, but you go out to the, Amarillos or Longviews, you're not going to see the development just because they can't afford the rent to pay for the new, what it costs to build a new apartment building.
I love it. That's a really good point of view that we haven't talked about on this show before. And I think that's, for the listeners, that's something that needs to be paid attention to. Is it's not a supply issue, it's a lending and interest rate and financial side issue that we're seeing right now.
Yeah, absolutely.
Kenny, you mentioned fund number 6. If someone wanted to learn more about that or get connected with you, where would they do that?
Sure. So our website's probably the best place to go. It's Wolfe with an E-investments.com. And that's probably the best place to go. And then I speak at a lot of events too across the country. So that calendar should be on there as well. And we're on social media. So you can find us pretty much wherever, but the website's the best place to go.
Awesome. We'll make sure that's down below. I also want to talk about 2 last things. The 2 books that you are an author of. Where can people find those?
So those are on Amazon, Amazon.com. You can find both of those. One's kind of the story. The first one was the story of kind of how I started Wolfe Investments, or the multifamily business. And the second one, I'm pretty passionate about personal finance. So I didn't like the last big book that was, and it's I'll pick on Tony. I love Tony Robbins, but man, that financial book was a cop out. So anyways, but because it was talking about mutual funds and all the just everybody's taught, to stay middle class. So this book was really kind of how the wealthy actually invest. And, folks, anybody can start on that path.
Yeah. And so the second book that you're talking about caters more towards alternative investments, if I'm speaking correctly.
Yeah. I mean, I still like stocks when they're on sale. I like preferred stocks too. I mean, I like all investments. I'm probably 95% invested in commercial real estate just because it's my business. But I've got investments in private equity, oil and gas, stocks, preferred. I mean, it's a wide range, but I love to invest. I'm definitely an investor first.
You're a collector of assets. That's a good collection to have.
All right. Yeah. Just when they're on sale.
Well, Kenny, thanks so much for telling us about the post office building in downtown Dallas that you guys worked on and own. Thanks for sharing about Wolfe Investments. And I encourage everyone that's looking to hear more from Kenny, check out his books, go to their website so you can stay connected with him as well.
Awesome. Appreciate it, Trent. Thank you very much.
Thank you for listening to this episode of the Real Estate Professionals Investing Podcast on WIN, your community of investing knowledge for growth. We hope that this episode has increased your knowledge and added value to your path to freedom. If you would, please take a second to rate us so that we can get more great investors to interview. If you or someone that you know wants to be on, please visit westsideinvestors.com and fill out our form to be on the show. Thank you again and enjoy your day.